The ground beneath Wall Street is trembling. A massive, silent sell-off of long-term U.S. Treasuries is underway, and it's sending shockwaves far beyond trading floors. This isn't just routine market activity. It's a critical symptom of deeper economic anxieties, threatening to reshape the American financial landscape in 2026 and beyond. Today, we're dissecting the causes behind this seismic shift, its current impact on U.S. debt, inflation, interest rates, and how savvy investors are adapting their strategies for the turbulent year ahead. So, why is Wall Street dumping long-term treasuries? One major driver is the sheer volume of U.S. national debt, which hit an astounding $38.09 trillion as of November 2025 and is projected to reach $39 trillion by March 2026. A significant portion of this debt, approximately one-third or $9.2 trillion, is maturing in 2025 alone, demanding massive refinancing and new issuance. Investors are demanding higher yields to absorb the supply. Secondly, persistent inflation, hovering near 3% and stubbornly above the Federal Reserve's 2% target, makes long-term fixed income less attractive. Investors demand greater compensation for the erosion of their purchasing power over time. Divergent global central bank policies, particularly the Bank of Japan hinting at rate hikes, are also influencing this trend. This can spark a global bond sell-off, with international capital potentially seeking higher returns elsewhere. Historically, major periods of Treasury sell-offs often coincided with rising inflation expectations or significant government spending initiatives. Think of the late 1970s and early 80s, when runaway inflation drove bond yields to historic highs. More recently, the post-pandemic stimulus and the subsequent surge in borrowing set the stage for our current predicament, demonstrating how fiscal policy directly impacts bond market stability. The impact on U.S. debt is alarming. The average interest rate on marketable national debt has climbed to 3.393% as of October 2025, a stark increase from 1.625% just 5 years ago. This translates to soaring debt servicing costs, projected to consume 13.85% of federal outlays in fiscal year 2026. Imagine the opportunity cost: funds diverted from crucial investments. Inflation remains a persistent headache. Tariffs are a major concern, acting as an inflationary tax that will likely lead to higher consumer costs and tighter labor markets in 2026. While the Federal Reserve is expected to make another rate cut in December 2025, with an 80% probability of a 25 basis point reduction, the long-term outlook for interest rates remains uncertain. Long-term Treasury yields, like the 10-year yield, recently jumped to around 4.09–4.11%. The yield curve, after a prolonged inversion, has normalized to a positive 53 basis points, but further steepening is anticipated. For investors, this environment demands a strategic pivot. A risk-off sentiment prevails, pushing capital away from speculative assets towards preservation and defensive plays. Higher long-term Treasury yields, despite their volatility, now offer more attractive income streams. However, their interest rate sensitivity means they're not without risk if rates unexpectedly climb further. In 2026, the U.S. economy faces significant headwinds. The OECD forecasts growth slowing to just 1.5%, a sharp decline from previous years. This points to a potential growth recession, or even a shallow recession. Key risks include the full impact of high tariff rates, potential job losses from AI adoption, and lingering uncertainty from geopolitical events and fiscal policy. So, what are the actionable lessons? Diversify your portfolio, especially with an eye on defensive assets. Reevaluate your bond holdings for duration risk, and consider shorter-term treasuries if long-term volatility persists. Staying informed and agile will be paramount. The coming months promise further volatility, but also opportunities for those who understand the undercurrents of this evolving economic saga. Subscribe to stay ahead